Good morning, friends. Today, I'm going to teach you about the risk management and derivatives. This is the paper that I will be handling for this particular semester. That is your fourth semester specialized paper. Now, you must understand before getting into the syllabus, we will understand what is this risk management and derivatives. First, we will understand the syllabus part. Another one is we will understand the question paper part. Now, what is this syllabus? Okay. So basically, here, as the subject says, the risk management and derivatives, there is not much on the risk management side, but there is some risk management side that is with reference to the capital budgeting. Now, what is this capital budgeting, and also what is this derivatives? Totally, there are two topics for you. One is the capital budgeting, another one is derivatives. Now, we will understand what is this capital budgeting. What is capital budgeting is you must have studied in your financial management, that is in your first semester, how to calculate net present value, NPV. Okay. Now, what is capital budgeting? If you are buying any asset, an asset could be an equipment, a plant, a fixed asset, a vehicle, or anything. Whether it is worth buying that particular asset. How do we decide? We decide based on net present value. What is net present value? Net present value is equal to present value of cash inflow minus present value of cash outflow. Now, this is called capital budgeting. Now, in this capital budgeting, sir, we have already studied capital budgeting in our first semester. Why are you teaching once again the capital budgeting? Now, here, what you studied in your financial management at the first semester level is little basic level. Here we will understand, as you know, there are two components in this. One is the cash flow, another one is discount rate. These both the things was already given in the problem. We did not take into account the risk factors, which we will study this semester. Okay. Now, this is about the capital budgeting. Now, you may ask me, what is the derivatives? Now, what is derivatives is, if you are entering into a contract to buy or sell any asset at a future date, what is that? Future date. For example, today I enter into a contract with Mr. X to buy gold at 4,800 per gram 3 months from now, which means what? Which means after 3 months, only you should give cash to me and I will give gold to you. Okay. Now, either buying or selling at a future date, we call it as derivatives. Now, why it is called derivatives? That we will come later. But this is nothing but future contracts. So, they give name for these three things. Three names they have given. What are these three names? They have given forward, they have given futures, they have given options. So what all these things are? These all things are contract for the future which is entered today. The contract entered for future today. Now, what do we study in this? We study what is forward, what is future, what is option, how it is entered, okay, and then how to buy and how to sell these forward contracts, okay, and what is the price of this, how to make a profit out of this. These are the three things we sell in the derivatives. This is entire your module 2 to module 6 is only about forward, future and options. So which means we are very clear, we are studying two topics here. One is the capital budgeting, another one is the derivatives. In the capital budgeting, little higher level problems. In the derivatives, we study the basic problem, but what is forward, what is future, what is option. This is the syllabus. Let's go to the question paper now. I taught you syllabus. Now, we will learn the question paper. Now you can see section A, section B, and section C. As you all know, section C is your case study, and 90% of this 15 marks problem is on capital budgeting. Okay, so the problem will be such a big thing, nothing to worry, we will solve that problem, but 15 marks will be capital budgeting problem. Okay, now in the 10 marks, okay, one capital budgeting problem we can see. So 15 plus 10, 25 marks. In 5 marks, again one capital budgeting problem. So 15, 25 plus another 30, 35 marks will come in the capital budgeting. Apart from that, the rest of the balance will be from other chapters. Now, now you can see this is a problem relating to futures. This is the problem relating to options. This is the problem relating to forward and options. This is the problem relating to capital budgeting. Then this is a problem relating what is forward and futures. So very clear. Now we will have the examination, capital budgeting approximately 40 marks and the balance another 60 marks. Even in the balance, okay, there is a problem on valuation. Now what is valuation? Now you must have studied in your second year, that is your third semester, valuation of shares. Valuation of shares. Now what is valuation of shares? For example, if Hindustan Unilever Limited is trading at 1200 rupees per share in the stock market, okay, what is the real value of this 1200? So we work out based on cash flow, which you must, based on your dividend divided by KE, you must have arrived at the P, what we call it as dividend by cost of capital, would have given you the valuation of share. Now this time what we do is we not only we don't study valuation of share, which is already been taught. Now we study how do we value the forwards, how do we value the futures, how do we value the options. In this three also, 90% of the time you will get around 15 marks from option valuation. Okay, future you may get 10 marks from the valuations. Okay, apart from this, see, very even in the forward future options, balance will be theory only with reference to valuing. How do we value the future? How do we value the options? Okay, if you work out this, there are 40 marks here. Here another 15 and 10. Easily you can score 70 marks. Okay, this is about the question paper. Now we will straight away, I think I have cleared. I will show you the question paper. I think I showed you the question paper. I'll also show you the syllabus. We can easily see capital budgeting. In this capital budgeting, we have to learn something called sensitivity analysis, scenario analysis, simulation, risk adjusted discount rate method, and certain equivalent coefficient method, decision tree analysis, and probability distribution method. Once again, I'll repeat it: sensitivity analysis, scenario analysis, simulation, standard deviation, risk adjusted discount rate, equivalent coefficient method, decision tree analysis, probability method. Okay, then this is the module 1. Module 2, we have what do you mean by derivatives? Very simple theory questions. Okay, what do you mean by future? What do you mean by index future? What do you mean by forward? What do you mean by margin? What do you mean by settlement mechanism, and so on? This very simple I will teach you all. Okay, these two topics we will take up today. Okay, then we will come to the future contracts. Now here you see derivatives overall I have to teach. The same thing I'll have to repeat here. What do you mean by future? Again I'll have to repeat what is option. Then how do we do option pricing? And then what is commodity? These are the two things. Once again, option pricing, I told you, how do we value it? Okay. Then there is what is commodity market. This commodity as well as this derivatives, both are theory. Okay, again, this will come out for 30 marks. So totally more than 130 marks, I have very clearly told you. So future contracts, it's a pretty simple one. Options, okay, again a theoretical concept. Only valuation, problem related concept. So we will take up one by one and we will try to understand. I think fairly I have completed my syllabus and question paper.